Good morning, everyone. Tim Nyland here. Today is September 2nd, 2020, and this is our internal strategy call for Zacks Professional Services. We've had a big news week this past week since we last met. Durable goods orders, a gain for the third straight month, up 11.2%, and this is after an increase from July as well as June. So this is a really good leading indicator of demand to come. So really positive for the economy. Also on Thursday last week, Fed Chair Powell eased the inflation targets, signaling that he basically wanted inflation to rise above its 2% target. And there's really two implications to this, right? So had it adopted this policy back in 2015, if you recall, we had several rate increases that began in late 2015. Those would have definitely been delayed. So the idea is that the Fed now wants inflation to run even above its 2% target so that we can average a 2% inflation rate. So the Fed, again, is going to allow inflation to run at or above 2% prior to actually raising rates, it's a huge shift. What does this mean for investors? What does this mean for advisors? It means that literally rates are going to be lower for longer. And this, again, is why we've seen another leg up in specifically the technology sector. That's been running hot, just continues to roll. Interest rates continue to be at record lows. This is a huge bullish indicator for equities, and obviously bad news again for the banks, which we are going to talk a little bit more about in just a moment. The next thing I want to talk about that made a lot of waves on the back end of the Apple stock split that was effective this past Monday. It obviously triggered many changes to the Dow, right? So Exxon, Pfizer, Raytheon are out. Salesforce, Honeywell, Amgen is basically in. And the logic here was that it helped to diversify the index by removing a lot of the overlapping companies with a similar scope. And this is pretty much what came directly from Dow Jones, their explanation. Again, I share this with you as my takeaways. The idea here is that it definitely helped to maintain the tech sector weight. The Apple split would have represented a smaller tech sector weight. And here's the interesting part of this whole thing is that even with the addition of Salesforce, it definitely added to the tech sector weight, but it's not a full supplement for the split that Apple went through. And that's even after Dow adjusted the divisor on the index. So my takeaway on this and what does it mean for investors, what does it mean for advisors, is two things. The technology sector influence in the Dow will shrink after the Apple split, even with the addition of Salesforce. And we all know how well that the tech sector has performed literally since 2012, 2013. And I would suggest that we start looking for even larger performance divergences between the Dow and the S&P now. There's always been some performance divergence. And now I think we look for perhaps even more, regardless of what happens to the tech sector. If it doesn't perform as well, or if it continues to outperform, you can see in this article the different sector weightings between the Dow and the S&P. I thought this was interesting, definitely worth a share. The energy sector, there's commentary in here, is by far the worst performing S&P 500 sector, down 40%, while the index as a whole has gained 6.6. That's not news to us, obviously. Energy stocks don't belong in core. I've preached this for years, and obviously this is the reason why. You can't time the market. These companies are very cyclical in nature, and they're more of a tilt than anything. Want to move on to the next piece that made the news that I found super interesting. And basically this chart here shows a year-to-date comparison of how the Dow looks would look today relative to its current membership had the changes in the Dow been effective Jan 1. And you can see it's a pretty tight mirror. We'll see how that plays out over time. I'm sure somebody will write a follow-up article on it. But the biggest piece of news in this particular chart is that they show the year-to-date components of the Dow that are the largest positive and negative point contributions. And I have stars next to all 4 of the top contributors to the Dow, because the top 2 are 2 of 6 of our tilts for the earnings certain portfolio, or even any core equity portfolio. And Home Depot and Visa are both ECP members, earnings certain portfolio members. So hopefully, if you're looking through the Wall Street Journal and you see stuff like this, you see something familiar in there. It's really great to see, and it's obviously it's by design. These companies that we choose for the ECP and the tilts, they're just bellwether stocks. They just show just tremendous performance consistently. Move on to the next piece of news that just continues to make news, and I hate to pick on the banks again, but they have obviously been in the news a lot, and it's not for good reason. Last week during our strategy session, I commented on 5 banks that are currently trading below their tangible book value. And for anyone listening to this call in recording, in other words, Adam sends this email out to our user base normally the day after, so that would be tomorrow morning. Be sure that if you haven't seen last week's video on some of the banks that I discussed and then a little bit of the strategy, what I'm going to talk about here in just a minute is kind of a follow-up to last week's call. So if you reference the email that you received when you're watching this video, at the very bottom, Adam includes a link that will actually allow you to click on and see the strategy session history. So watch last week's strategy session call. And the idea here with this article I found extremely interesting is they're talking about the fact that since COVID, bank customers have literally flooded the banks with cash by way of deposits. And what I found even more interesting is that it's so much cash that the nation's safety net for bank failures fell below one of the particular legal limits. And this chart specifically shows the collapse in net interest margin. And this is one of the things that I talk about all the time, is that the net interest margin is so critical in being able to determine when we're going to actually have a positive slope in the yield curve and when we're going to see spreads at the various tranches begin to widen. And that's when banks can really start making a profit. And that net interest margin, again, is that spread between interest on deposits versus loans. And the real takeaway here, if we take what's presented in this article and kind of extrapolate it, and we're actually going to dive into Advisor Tools here in just a minute and look at some of the financial statements for some banks, is it's really contributed to what I like to call a net margin collapse for certain banks. And specifically, those banks without large investment banking operations, they haven't ratcheted up their fees, or they don't do a lot in terms of trading, have probably suffered the most. So what I want to do now is just, take what this article talks about. They also talk about, obviously, this massive ramp up in loan loss provisions, which is going to do nothing but pressure margins as well. So I want to take everyone into Advisor Tools, and I want everyone to pay particular attention to the keystrokes here. And we could do this one of 2 ways. If we had a bank stock, I don't really follow too many bank stocks on my watch list, as you guys know. I'm not big fans. But I could just throw in Wells Fargo ticker symbol up here in the symbol monitor, click on it, and when you do that, you're going to get launched into what we call our interactive desktop. And tons of great information here across the tabs. I like to scroll all the way over to the right on financials when I'm looking to verify this financial statement data. what I want to discuss with everyone here is a few things, right? If you click on any of the dates, all right, these are going to be hot links right out to the actual SEC filings. So if you're clicking on an annual point, you're going to get the K. If you click on a quarterly period, you're going to get the Q. Any of this information can be exported directly to Excel by clicking this link here. And you might find that helpful after we talk a little bit about what I'm seeing in these financial statements. But the real key here is in the setup. And so if we want to take a look at the amount of cash that's hit the bank since the COVID crisis, the very first thing we're going to want to do is look at interim financials, not annual. And what we're going to want to do is pay attention to Q4 deposits relative to what's happened in Q1 and Q2. So we're going to focus on these three columns here. And the very next thing we're going to want to do is, since deposits is going to land on the balance sheet, we're going to want to change the form type to balance sheet. And then we're going to go ahead and limit the number of line items that we see only so we don't have to scroll down as much. And we're just going to look at standardized. So this is where we normalize the accounts and group things together so it's a little bit easier to compare company to company. And note that when you make these changes, you have to click on Update Report. And the very first thing I want everyone to see is interest-bearing deposits. And this is Wells Fargo. And again, I want you to pay attention to the Q4 number, 119, to the Q2, 237. That's literally 2x the amount of interest-bearing deposits in 6 months. This is a massive ramp up, and I can see exactly what the Dow Jones article was referring to. And interestingly enough, if you do the same with this line item down here, which is the loan loss allowance, you'll see that at the same time they've taken in 2x the amount of deposits, they've also doubled their allowance for loan losses, which is obviously going to present challenges going forward. And it's interesting because if you just do a couple random checks, and again, I'm just going to put JP Morgan in here and do an update report. I always like to look at a couple stocks just to make sure, hey, it's just not, Wells Fargo. We know that Wells Fargo is a huge depository institution. But if we look at interest-bearing deposits for JP Morgan, and I'll just highlight this line item so it's easy for everyone to see, it's another 2x. I mean, it's gone from 241 to 473. And so this is definitely a consistent trend, and the Wall Street Journal literally nailed it. Provision for loan losses, almost 3x for JP Morgan, going from 13 to more or less 32. So again, just be advised that the financial statements tab in here is super powerful. Make sure you're looking at your form type correctly, the format, and make sure you update the report after you make the changes. We also have originally reported and restated. Obviously, I'd like to look at anything that's been restated. It's definitely the more preferred way to look at it. If you're a quant and doing any sort of quantitative analysis, you're going to be more interested in looking at it as originally reported. So that's a little bit of the difference there. The next thing I want to do is take everyone into the Zacks Research System and just take a look at how these changes have put pressure on net margin, right, before non-recurring items. This is going to be an adjusted net margin. It's going to exclude any non-recurring one-time events, so it's a clean net margin. And what I want to show here and look at is you can see that JP Morgan has literally kind of been on the slide ever since its recovery from the financial crisis in 2010. In other words, net margins have been slipping. And they are currently sitting right at median, so I don't see too much in the way of trouble there. But again, if we're going to look at JP Morgan, let's take a look at a couple others. And keep in mind that your primary contributors are going to be bank fees, your net interest margin, investment banking operations, trading activities, and that sort of thing. So if we know that margins have collapsed because of net interest margin, and we see JP Morgan holding up fairly well, we know that they're making up for it in fees, and they're making up for it in investment banking and trading and other areas. let's take a look at what Bank of America looks like. Bank of America is interesting because they're actually doing a very spectacular job at maintaining their margins in the face of this collapse in net interest margins. So, and again, if anybody needed more reason as to why Bank of America and JP Morgan are not only my two top bank picks, but also our Director of Research, Shiraz Mian, you'll find these two names on the focus list. That's the reason. Take a look at a name like Wells Fargo. And here is a sad case, right? So not so much the same story for Wells Fargo. As a matter of fact, their net margin has literally collapsed to levels that they didn't even see in the financial crisis. And so, is there really any wonder why Wells Fargo is one of the 5 banks trading below their tangible liquidation value that I pointed out in last week's call? If you didn't watch last week's call, obviously more trouble ahead for Wells Fargo. They've got to get this stuff turned around. Please listen to that call. Anyway, I hope that gives everyone a lot to think about. Again, the news for the financials, it just isn't getting any better. I wish it was. They're a great tilt when we do see rates rise and when we do see those spreads at the various tranches. When I'm talking about tranches, I'm talking about the various maturities along the yield curve. So anyway, that's all I had for today. Thanks everyone for attending, and we will pick up this discussion again next week.